Welcome to the program. Today we'll look at the stock market and all the upcoming economic data. We'll discuss an eccentric fund manager and we'll look at property prices and interest-only loans. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money. Paul, markets have been, I guess, doing it reasonably tough in May. You know, probably the worst performing month since January 2016. That old adage, sell in May and go away, has it happened, or is it still going to play out?
I think it's got a bit further to play out, Marty. In fact, it's proving to be pretty accurate. I mean, since the banks have had it done really tough, since the 1st of May when they peaked, they're down on average between about 10 and 11%. That's even adjusting for the dividends. No, I don't think they're quite a buy just yet. I'm a little on the cool side, Marty. I wrote that in Switzer Super Report on Monday. I just
and on Thursday you said that the bank should just cop it and suck up the levy.
Yeah, the bank should just cop it and suck it up. They're still sort of making a little bit of noise, but the legislation will go.
Except for Macquarie.
Except for Macquarie, who said absolutely nothing.
Well, they don't want their $1 million bonuses affected, do they?
They don't want being affected. Look, I think, as I wrote in the thing, I think the way to read our market at the moment, we're not going to ignore leads from the US. So if the US keeps rallying, our market is going to follow. It's just going to lag, in my opinion. I think it's going to underperform.
What can take the US higher at the moment? What are the key headwinds or the key issues to look at?
It just doesn't want to sell off over there, right?
Yeah.
I mean, volatility's at a record low. Interest rates are low. You know, we don't know quite what's going on with the Trump circus, but you expect more positive noises about their budget plan, tax plan. You know, the technology shares are really strong. You know, last night Amazon over $1,000 for the first time. So, but that said, you know, it's not making a lot of headway, but I think it still will set the basic tone for our market. I just think we're going to underperform, and I think we need to pull back a bit to find some value. I'm not seeing a lot of value just yet.
Well, that's a good segue into a fund manager that's actually made the press recently, who we know we've done some work with.
Who we know quite well.
Yeah,
but,
through a number of our media channels, but Phil Parker, Altair Asset Management, has just come out and basically said he's selling all his stocks and he's exiting his portfolio and he's getting out of the industry. How much money was he managing? Is that been realised?
I think we're almost in very low $1 million. There's some figures out from Morningstar that says that the fund amount is less than $20 million. He claims he's got a lot more in other mandates, so who knows?
He could have some SMAs. He could have some SMAs. He could have. Or something.
Here's the. You know, I think you summed it up well. Eccentric money. Look, let's look at his arguments. Okay, geopolitical tensions. Okay, they're not new. They're staying. Can't argue with there's some issues around the geopolitics. He's worried about Trump. Well, you know, I'm not sure Trump's actually a bear factor. The American political system is pretty stable. If Trump gets impeached, Pence takes over. It's not the end of the world. But anyhow.
Keeps the bang going.
Yep. Thirdly, house prices. He's worried about the sort of housing market here. Okay, there's some risks here. And then fourthly, he's worried about banks because, of course, their main asset is property loans. So, look, I don't think the world's about to fall in. But, you know, these guys, there's always someone out there telling you that. And he's got an amazing amount of publicity for someone who seems to be managing such a little amount of money. And I think you said it. We'll be nice to him. We'll call him eccentric. But look, the press just loves this. It just feeds the ABC and Fairfax.
Anything to talk about passive investment, market's about to collapse. We'll get headlines with the press. Just like property prices.
Anyone likes property prices. And now that's probably a good segue into property prices, mate.
Yeah.
Because now we don't even have to wait to the end of the month. Now we have pre-end of the month figures from CoreLogic coming out of the 28th and the 29th of May, 2 days before the end of the month, so we can tell us what's going to happen in May.
That will create another negative story to say how bad things are possibly going to be when that number comes out, as opposed to reporting on just the number itself.
Yeah. I think we are in for a bit of a tough time. There's a big data out next week with the GDP for the March quarter. A few economists saying that could actually be negative or close to zero mainly because of the impact of cyclone, not Tracy, but the one in Queensland in March.
Yeah.
But I think the R word might be you might start to see that we'll make it into the media late this week, early next week as we get a read on that. Another reason perhaps just to be a little bit cautious on the market. But on
property as well, interest-only loans.
So banks under a lot of pressure here from the new APRA directive. They have to get. It's not going to be an historic directive, but as I understand it, they're going to need new loans. They're going to be able to do 30% interest only. Currently, one of the majors is around 50%. Another one's in the high 30s.
Yeah.
So if you've got an interest-only loan, there's going to be a lot of pressure from banks to make them principal interest.
Some punter came out during the week too in the press saying that interest-only, and it was some sort of market analyst said interest-only loans could be the next subprime.
Yeah, I don't think that's the case, but it could certainly impact some property markets. You know, some of the wealthier parts of Sydney and Melbourne and Brisbane, where perhaps interest only is a little more common because people just can't don't have the incomes just to pay principal off.
Yeah, and believe the prices is going to keep going up.
Prices, you know, could have some impact there. I think if you're on an interest-only loan and you're under pressure to go back to P&I, shop around. And if you are an interest-only loan, it's going to get a lot more expensive. And if you do have the cash flow, you know, you might not want to pay the extra 30 or 40 basis points margin for interest only and go back into principal interest simply to get a lower interest rate.
May mean start doing a budget.
It may mean start doing a budget. So there's my tip. And investors, particularly who've got prepaying interest, look very, you know, again, that's a good strategy, but all that's doing is bringing the tax deduction forward from 1 year to the next. It may not actually make a lot of sense to prepay. So just have a look at those numbers, particularly as you come up to 30th of June.
That's all we've got time for. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money.